Debits, credits, and T accounts with Mrs. C. Today we're going to talk about how debits and credits impact the accounting equation and how T accounts can be used as a visual representation of the transactions that impact a business. Now, before we get started, if you haven't had a chance to go out to Google Classroom and read the lesson text for 3-1, I highly encourage you doing that. It'll really help you with the concepts that we're going to talk about in this lesson. So go ahead and bounce out of this recording, read that text, and come back if you haven't done so already. If you've done so already, let's continue on. Have you ever thought about how Newton's third law of motion is like double entry accounting? Probably not. Do you know what Newton's third law of motion is? If you don't know what it is, we'll definitely talk about throughout the session and how it is very similar to double entry accounting. So think about that for a minute, put it in the back of your head, and we'll come back to it later. So today's objectives. Our objectives are to explain the double entry accounting system, understand T accounts and how and why they are used to help analyze transactions, identify and recall the debit and credit side of a T account, identify the increases and decreases side of the 3 balance sheet accounts, and identify the normal balance of each of those 3 balance sheet accounts. So what is double entry accounting? Just by definition, if you think about it, double is 2. So we have 2 entry accounting. So what does that exactly mean? Double entry accounting is an accounting system that requires every financial transaction to have an equal and opposite effect. It's recorded in at least 2 accounts, where one account has a debit and one account has a credit. But what does debit and credit mean? Well, this system was made back in the 1400s and is still used today. And it's actually the financial background for all of accounting. So we're going to review until you get this concept. But it definitely is the backbone for everything that we're going to build on throughout our year. So let's get started. So let's remember the accounting equation. We've been talking about this a lot lately. It's ALLO, right? Assets equal liabilities plus owner's equity. Our assets are what we own. Our liabilities are what we owe. And our owner's equity is what's owed to the owners. Our assets are on the left-hand side, and our liabilities and owner's equity are on the right-hand side. So assets are always on the left, liabilities and owner's equity are always on the right. So if you remember from our last session, this is one of our transaction detail lists that we had. So we had our accounting equation, we had the accounts that were impacted, their old balances and their newer balances. This just really showing that our assets equal our liabilities and our owner's equity. Now in real business, we're not going to show something like this. Large companies have thousands of transactions, hundreds of accounts. It just really doesn't make sense to put it in this format. It's just really not practical, but it's okay. This right now just gives us an idea of how all those accounts that were impacted by the transactions fit into the accounting equation. Now, what you will notice is that the assets equal liabilities and owner's equity, it forms a T right at that equal sign. So we have assets on the left and liabilities and owner's equity on the right. So let's talk about some T accounts. I have some numbers thrown up on the screen there, and I'd like to introduce you to a few of my favorite T's. So first and foremost, you have Mr. T. Mr. T is a famous actor. If you don't know who he is, I pity the fool. Another famous rapper we have is Ice-T. And probably the most famous one today is our T Swift. Now, these are some of my favorite T's that I'd like to introduce you to. Now, Mr. T has a net worth of $1 million. Ice-T, 65 million, and Taylor Swift coming in at a cool 1.3 billion. Now, today we're not going to talk about net worth, but it's important to note that everything that we talk about, whether it be our accounting equation, how our transactions impact the accounting equation, all builds into how we calculate items that impact financial statements, and in the end, figure out what the net worth is for people or for companies. So just trying to stress the importance of the accounting equation, the debits and credits. Well, it's super foundational to everything else that comes in accounting. So later we'll talk about some net worth, how these items get calculated. It absolutely uses the accounting equation, but let me introduce you to a couple more T accounts. So the T accounts we're going to be talking about today are going to be the accounting T accounts. So our transactions will impact our accounts, whether they're going up or they're going down for our balances. Each accounting balance represents the total of all of the past transactions of the account. So when we're looking at a T account, we're looking at the accounting equation, we're taking those transactions, we're adding and subtracting different items, and we're coming out to the ending balance. The T account is just a visual representation used to analyze the effect of the transactions have on an account. You can see it's down there in the right-hand corner. The T account has a debit side and a credit side. Recall in double entry accounting, it states that every financial statement has an equal and opposite effect. Ever heard of equal and opposite effect before? We'll come back to that. Recorded in at least two accounts, so double entry, at least two, where there's at least one debit and one credit. So if we have three accounts that are impacted by a certain transaction, we might have two debits and one credit, or two credits and one debit. But either way, the debits equal the credits. A T account is separated into two separate spots and two separate parts, which is your debit and your credit, as shown in that visual down there. Now just a bigger visual, and we're going to keep going over this. Our debits are on the left and our credits are on the right. The debit is an accounting transaction entry on the left side of an account. The credit is an accounting transaction entry on the right side of the account. All right, pause, take a break. We're going to commit this to memory. Debit on the left, credit on the right. Whatever you have to do to commit this to memory, do it now. So if you have to do some Cupid shuffle to the left, to the left, to the right, whatever you have to do to commit this to memory, you need to do that. Debit is on the left, credit is on the right. This is my favorite visualization of kind of the accounting equation and the debits and credits. So our assets are what we own. They equal our liabilities and owner's equity. So you can see those two boxes there. Right now they're 50-50, but normally they're not. But if you add those together, they equal the assets, which really is our accounting equation. Asset equal liabilities plus owner's equity, and it creates a T, right? So our T account, debits on the left, credits on the right. All right, so let's go into our first knowledge check, right? So I just want to make sure that you're catching on, that you're understanding what's on the left, what's on the right, what do we debit, what do we credit. So scan the QR code. It's going to take you to a Google form. Answer these 4 questions. They're just multiple choice, no biggie. And then hit submit. If you got any wrong, it would just let you know what the right answers are, which is great. We're going to continue to review, but this gives me an idea of if you're understanding this concept. So if you are unable to maybe scan that QR code, I put a link to the Google form in the description here, and there's also one in Google Classroom. So go to the YouTube video to the description. You can find the Google form there for Knowledge Check 1 and get you into that form. It should just take you about a minute. So let me give you about a minute to answer those questions, and then we'll continue on. All right, so let's talk about some T account mechanics. The double entry accounting system has rules. In accounting, we love our rules. So we have our GAAP rules, we have our internal revenue system rules. There's lots of rules, and rules are important when it comes to accounting. We want to make sure that everyone is consistently logging transactions and creating financial statements the same way, consistent to the rules that are out there. This gives us confidence in those financial statements that I was talking about earlier to make business decisions. So the most important part of accounting is the end result accurately reflects those transactions that happened during that period. So let's talk about some of these double entry accounting system rules. So again, double entry means two. Two accounts are affected, at least two, sometimes more. One account gets debited and the other gets credited. The total amount of your debits equal your total amount of your credits. Debits equal credits, debits equal credits. Always. So important. When recording a transaction, it's good to ask these 4 questions. Number 1, what accounts are affected? What accounts are impacted by this transaction? What accounts get debited and which ones get credited? What account classification does each account roll into? So is this account an asset, a liability, or owner's equity? And how does each account classification change? Does it go up? Does it go down? Is it increased? Is it decreased? If somebody pays me money, my cash goes up, right? Like somebody hands me some cash, my cash goes up. I know that cash is an asset and assets have a debit balance. So I'm going to debit that cash account and it's going to increase. So that's kind of how it all flows together. If 1 equals 1 equals 1, it gets us to the end result of our T account and our account balance. All right, so what's our normal balance? So your normal balance of an account is the side that increases. So like I just said, cash, if I get cash, I'm going to debit it. So my normal balance is cash, is a debit. All right. So normal balance of assets. Assets are on the left side of the equation, so it's an increase. Any asset account, the account must be debited because assets are always on the left and the left is a debit, okay? The normal balance of an asset account is the debit side. A normal balance of liabilities. Liabilities is on the right side of the equation. So an increase to any liability account, the account must be credited because liability is on the right and the right is credit. Now, a way that I like to remember the normal balances is that assets and liabilities are op. So they're opposites. And so if assets, I'm going to increase with the debit, liabilities, I'm going to increase with a credit, right? Because that keeps them equal. So assets, normal balance is a debit, and liabilities, normal balance is a credit. They're opposite from each other, what I own versus what I owe. Completely opposite, they have opposite normal balances. Now, normal balance of owner's equity. Owner's equity also sits on the right side of the equation. So to increase any owner's equity account, the account must be credited because owner's equity is always on the right side and the right is a credit. So this means the normal balance of the owner's equity account is on the credit side. It's also on the opposite side of the asset. Okay, so it's on the opposite side of the accounting equation as the asset. So that means that its normal balance would be opposite of assets. So that's why we have liabilities and owner's equity both have a credit normal balance when assets have a debit normal balance. All right, back to my favorite visual. So we have our assets, we have our liabilities and our equity on the other side. Assets are debited, liabilities and owner's equity are credited. Assets on the left, liabilities and owner's equity on the right. Now, how do we apply this to a transaction? So we learned this, what increases, what decreases, how do we apply transactions to this debit, this credit, this T account? Whew. All right, transaction one. Let's talk about whack-a-mole. So have you ever played whack-a-mole at a arcade? Maybe I'm dating myself a little bit, but I think they still got it at Chuck E. Cheese. So the whack-a-mole is when you had that big like foam mallet. I guess it would be the mallet. And as soon as you hit one mole, another one pops up and you have to hit another one, right? So when we're talking about a transaction, we received a cash investment from a business owner of $5,500. And the first thing we want to do is say which account gets debited. Well, we're looking at the accounting equation. We know for a fact that we got cash from somebody. So we know cash is an asset. So if my cash went up, I would have to debit cash because it would increase it, right? So our assets go up because our cash goes up. So $5,500 there. So now what do I credit? So thinking about this, what do I credit? I know what I debit, I have to credit something. Looking at the other side of the equation, I have liabilities. Well, the business owner invested $5,500 cash. So do I owe anybody anything? No. Does it impact my liabilities? Because liabilities are what I owe? No. So it has to impact my owner's equity. And if our normal balance of owner's equity is a credit and we're increasing the investment the business owner has in the company, we're going to increase our owner's equity. And the account that we would use would be a capital account. So Serena Garcia's capital account goes up. The amount of equity or investment that she has in the company goes up. Our assets go up because now we have more cash and we are in balance. So let's talk about those 4 questions. What accounts are affected? Our cash and Serena Garcia capital. What accounts get debited and credited? So we know that cash got debited and credited the capital account, right? What account classifications does each account roll into? Well, we know cash is an asset and we know that capital is equity. How does the account classification change? We know our assets go up, we receive cash, and we know our equity goes up. We increase the investment in the company for that business owner. Now, how does it impact the T accounts, or how does it look in our T accounts? So you can see the DR and the CR. Debit is abbreviated as DR and credit is abbreviated as CR. You can see we have a debit to cash of that $5,500. That's now our balance and cash. And we have a credit of $5,500 to the capital account, which you'll see that at the bottom there. Now let's look at another transaction. We purchased video equipment for cash for $2,300. All right. So back to my favorite graphic here, we have our assets and our liabilities and equity. So we know we purchased video equipment for cash. So I paid cash. So I know my cash decreases, right? And what did I get for it? I got equipment. So now I own this equipment, which is an asset. So my 2 accounts that are impacted are equipment and cash. Equipment is an asset account. And cash is also an asset account. Whoa, we haven't talked about this yet. We've been talking about one side of the equation impacted and another side of the equation impacted, right? Well, there's times when only one side of an equation will be impacted. But as long as the equation in a whole remains in balance, we're good to go. So let's look at this transaction. So we know equipment is an asset. It's debited. Our equipment balance goes up. We have this equipment, $2,300, and we paid cash for it. So we credit cash. We decrease our cash account. So basically they offset each other. No overall impact to assets, and our liabilities and our equity remain the same. So our accounting equation is still in balance. Pretty cool. All right, let's look at another transaction. Transaction number 3. I love transactions. So on March 3rd, we paid cash for an annual insurance policy. So what accounts are impacted? So we paid cash, so we're giving them cash, so we know our cash is going to be decreased, right? An annual insurance policy. So I'm paying for insurance for the future, right? So you kind of prepay insurance in case something happens in the future. It doesn't happen at the time the insurance ends. So an annual insurance policy would be prepaid insurance. So since I have that prepaid insurance on the books, and it hasn't expired yet, it's considered an asset. It's considered an asset until it's used. So our two accounts that are impacted are cash and prepaid insurance. They're both asset accounts again. So our prepaid insurance is a debit because our balance goes up. Our cash is a credit because our cash goes down. And you'll see that our accounting equation is still in balance because overall there's really no impact or change in the balance of total assets, liabilities, or equity. So up prepaid insurance, down cash, everything's still in balance and the world is good. All right, transaction number 4. You purchased $325 of supplies from Lex Supply on account. So this one's a little bit different, right? So I'm buying supplies. What accounts are impacted? So I purchased supplies, but I didn't buy them with cash. I bought them on account. So I'm going to get the supplies. Those are considered an asset, right? So now I owe this vendor. So that's considered a liability. So that would be an accounts payable because I need to pay that vendor or that creditor at some point in time. So our accounts that are affected, supplies and accounts payable. Supplies is an asset account, accounts payable is a liability account. Supplies increases and accounts payable increases. Assets have a normal debit balance, and so supplies increase with the debit balance, and then accounts payable has a normal credit balance, so that also increases. And it ensures that our accounting equation is still in balance, which is the main focus here. So total assets equal our liabilities plus our total equity. Fantastic. All right, so let's take a look at all the T accounts now. So we just had, what, 4 transactions. We have some asset accounts, some liability and owner's equity accounts. You can see the change in, especially the cash account. So we had that initial investment at 5,500, but we've had we paid some cash out. So we had a decrease in the 2,300, decrease in the 500. So you can see that our balance is now $2,700. And then if you take a look at some of the other accounts, you'll see that they also have balances. So in the end, what we want to look at is to make sure that our assets, so if we tally up our cash, supplies, equipment, prepaid insurance, we're at 5,825. And that should equal our liability. We only have one liability, accounts payable, the $325, plus our owner's equity, which is our capital account, which is $5,500. So we look at this way, adding up our T accounts, looking at our balances, our assets equal our liabilities plus our owner's equity. Our debits and credits are in balance. So if you were to add up your debits, which is the 2,700, and you can see that our debit balances are our assets, right? And our credit balances is our liabilities, and our owner's equity. Our debits equal a credit, and we are good to go. Now let's take a look at owner's equity. Owner's equity gets a little complicated, or just a little more detailed. So owner's equity is the owner's rights to the assets of a business after all liabilities have been paid. So the amount of owner's equity really is assets minus liabilities, or the net worth that they have in the company, assets minus liabilities. So the equation we want to look at is owner's equity. It has its own equation. So you have the owner's capital account minus any owner's distributions plus revenues minus expenses. That's a interesting equation. So let's talk about revenues and expenses because we haven't really talked about those yet. So revenues minus expenses equal your net income. Your revenue increases your owner's equity. So think about that. If I sell something, I get money, and so I'm increasing the money in the company. So it increases your owner's equity. If I have an expense, I decrease owner's equity and I decrease the net income of the business, right? So revenue increases owner's equity, expense decreases owner's equity. All right, so let's take a look at it in this graphic here. So we have our assets. They're still going to equal liabilities plus owner's equity. Inside of owner's equity, we have these extra accounts or these sub accounts. So we have revenue and expenses. We have capital and distribution. So if I am going to get revenue, it's going to have a credit balance. If I increase capital, it's going to have a credit balance. If I have an expense, it's going to have a debit balance because it's ultimately going to reduce my equity. And if I have a distribution, meaning the owner took a distribution, took money out of the business, it's going to decrease your equity. Okay. All right, so let's take a look at the impact of equity account classification. Here's our formula again, the expanded accounting equation, as we like to call it. So it's just giving us more detail about what is all inside of that owner's equity, what makes up that owner's equity. So if owner's equity, the capital account increases the balance, distribution decreases the balance. So if I invest more money, increase my capital account, it increases the equity. If I take money out, it decreases the equity. If I sell something, get revenue, it increases the equity balance. If I have an expense, it decreases the equity balance. Okay, so think about it just like your normal day-to-day owner's equity, right? If I make money in my job, I increase my owner's equity. If I buy Starbucks, it's an expense. It decreases my money that I have. So kind of just think about it that way of how you would increase and decrease your own bank account, which in the end is your equity that you have in yourself, you as a business, your personal self. Everybody's their own little business. With your checking account, and you have the money that you put into your checking account, you have your distributions, the money you take out, the money you add in, and the expenses that you have. Okay. All right, so these are the normal balances of the equity accounts. So we've been talking about the assets and liabilities, but now let's dive into the owner's equity. So owner's capital and distributions. Capital increases equity, so it's a credit balance. Distribution decrease your equity overall, so it has a debit balance. So I always think owner's capital and distributions are opposites, so they have opposite balances. Revenue expenses are opposites, so they have opposite balances. However, it helps you to remember this is the best way. We always start with the accounting equation. Assets equal liabilities plus owner's equity. Assets are on the left. They have a debit balance. Liabilities and owner's equity are on right. It has a capital balance. And then when we dive into those owner equity accounts, we think about how do those impact owner's equity, and owner's equity has a normal credit balance. So if we know that the item increases owner's equity, it has a credit balance. If it decreases owner's equity, then it has a debit balance. And I hope that's helpful. All right, so let's get into some transactions because the best way that we can learn this is actually apply it. Taking those transactions and applying it to these, the T accounts and the accounting equation will just really help us with understanding it. So we received cash from services performed. So we're going to say I'm a service business. So that service business, I could be selling haircutting services, any type of service, dog grooming place, any place that's a service. An accounting business is a service business. So I'm performing a service, some type of service that benefits my customer. So we received cash from one of our customers for services we performed. So let's take a look at this. What accounts are impacted? Well, we know we got cash, right? So if we got cash from a customer, our cash goes up. So we can say that absolutely for sure. And our services performed. Now, the services is how we make revenue. That's our business. So it's what we sell. So that would be a revenue, which is in our equity area, right? And so revenue increases our equity, so it would be a credit. So let's look at our accounts impacted. We know cash is impacted and our service revenue. Cash is an asset account and service revenue is a revenue account that impacts owner's equity, okay? So cash increases, service revenue increases, which also increases owner's equity. So assets have a normal debit balance, so cash increases via debit. Revenue has a normal credit balance, so service revenue increases with a credit. Good. All right, transaction number 6. So we sold video services to Limestone Grill on account. So here's this account thing. Earlier we bought stuff on account. This time we're selling stuff on account. So before we owed people stuff, now people owe us money. Let's see how that impacts the accounting equation, right? So we sold video services to Limestone Grill. So remember, when we sell something, we sell our services, we know that that is a revenue account. So we're gonna say that that's our services revenue again. We could have a special account for that type of revenue if we wanted to track it separately as video services revenue, but I think for this one, we'll keep it as simple and services revenue. And then we sold it on account. So we don't owe anybody, somebody owes us. So we will receive that money. And so selling something on account, since we will receive the money, is an accounts receivable, and that's considered an asset account. So let's take a look at the whole transaction. So our accounts receivable and our service revenue are the two accounts impacted. Accounts receivable is an asset account and service revenue is a revenue account that affects owner's equity. Our accounts receivable increases with the debit balance and our service revenue increases with a credit balance. You can see here that our assets and our liabilities plus our owner's equity are all in balance. We have a debit and we have a credit. They equal for the same amount and we are in balance. All right, so now let's check number 2. You have transactions 7, 8, and 9. These I want you to do, take a moment right now and work on these transactions. You can scan the QR code and go out to that Google form. There's going to be some transactions. These 3 transactions are going to be out there. You're going to take a moment and actually answer those transactions. If you need to pause the video, go ahead and do that. You want to take those 3 transactions and put it into this accounting equation or this grid that we've been looking at, where our assets equal our liabilities plus our owner's equity. Contemplate, think about your 4 questions. What accounts are affected? What classifications are each account? Are they assets? Are they liabilities? Are they revenues? Are they expenses? Are they owner's equity? And how does that account change? Is that account increased or decreased? And then what accounts are debits and credits? And always at the end, you want to make sure your accounting equation is in balance and your debits and your credits equal. So I'm going to say, go ahead, pause the video. You can work on these questions that are on the Google form. Once you hit submit, again, you'll get your answers right away to these questions so you can check yourself, really get a feel for if you're understanding what we've been working on today. And then it also gives me a way to gauge, like, do we need to do more work on these transactions? And we can continue to review them in our next session, but it's a great way for me to just get a quick check. They won't be graded, don't worry about that, but I do expect you to complete the Google form. So go ahead and take the next 5-10 minutes to work on this, whatever you need to have here, hit pause on the video and then start it back up when you're ready. Okay. All right. So hopefully you got the right answers to that knowledge check number 2. If not, no worries. We will review. But as we take a look at what we've talked about today, the normal balances are extremely important. So normal balance of an asset is a debit. The debit's on the left-hand side. The assets on the left-hand side. The debit's on the left-hand side. It's an increase. So the normal balance of any liability account is on the credit side. It's on the right hand of the equation, and it's an increase. The normal balance of the owner's equity account is a credit. It's on the right-hand side, and that's an increase. The normal balance of the owner's distribution account is a debit. It's on the left-hand side, and it's an increase. The normal balance of a revenue account is a credit with an increase. And then the normal balance of an expense account is a debit, and that's an increase. So assets and liabilities are opposite from one another. Owner's equity and distributions are opposites. Revenue and expenses are opposites. And you can see that they would have an opposite normal balance. So let's go back and take a look at the normal balances of accounts. In a graphic, a little bit easier than all those words in the past slide there. So we have our increase and our decreases, our right and our left-hand side of the equation, which is very important. And then you can see how that owner's equity, once we drill into it, finding what increases and decreases our revenue and our expenses. Fantastic. All right. So some independent practice. I want you to log into Google Classroom. There's a couple exercises on Business U. You're going to take a look at Module 3-1, Exercise A, and then work on the Recall 3-1 Quick Review questions. The Exercise A is going to be an interactive exercise. You're going to be able to select debits and credits based on the different accounts that are out there. It's kind of fun. Has a bunch of drop downs. And it's pretty quick to just reinforce the concepts that we talked about today. And then the quick review questions has some glossary terms out there. It has some more transaction practice, but just some ways to recall everything that we worked on in this session and get you ready to drill a little bit deeper in our next session. So if you have any questions, feel free to email me. I'm sure you'll be fantastic, but reach out if anything isn't working for you. All right, so as I promised that I would come back to the whole Newton's third law of motion. So if we take a look at Newton's third law of motion, it's for every action, there's an equal and opposite reaction. But I like to say for every transaction, there's an equal and opposite reaction. So with that, I hope you have a fantastic day, and I'll see you at our next session.